I know this topic is, growing a startup through M&A. And why I kept this topic, because India is a startup country. Lots of a startup, every day I think there are a startup which are getting built. And I know you all are part of, company where you are working. And so there are a couple of questions we have outlined here. So maybe I will start with Ashutosh first, because you do lots of research work. So India have been in frontline building a startup for the world. What are different growth opportunities a startup can explore?
Thank you, Dharmendra. Good evening, everyone. I think we are all been hearing in the news quite frequently in terms of how India is a hotbed when it comes to startups. A lot has been written and spoken about in terms of India today. I think ranks amongst the third in terms of being the startup hub of the world. There is a lot of relation in terms of how the ecosystem has been growing and vis-a-vis why the startup community is doing so well. If you realize whether it is indices of all the other countries in terms of the stock markets or in terms of the economy or in terms of the inflationary conditions of every other country, they are pretty much suffering. They are all in the negative. Everyone is reporting a negative growth rate. India is the only country where we actually have a positive growth rate. We are still able to maintain a certain GDP, which we are quite happy about. The inflationary conditions still are in control. And a lot of that has to do with our whole population base and how things have improved in terms of the economics of the country, in terms of the aspirational value of people and how they've been growing. Because of the large size or the base of the population, in spite of the whole COVID impact and what happened post that, Indian economy was able to bounce back in a much faster manner as compared to the other countries. And one reason for that actually is the whole startup ecosystem which enabled this to happen. When the whole COVID scenario happened, the speed with which we actually migrated to online teaching was remarkable. If you see the size of our population, the number of students, my son is in 5th standard, so I can really see how the teachers and the whole ecosystem migrated from what we believed was a very fundamental part of offline, which can never be moved into online, to suddenly the whole ecosystem moving to an online base. A lot of people who are not wanting to buy online suddenly moved the whole ecosystem towards online. So whether it was in the form of health, whether it was in the form of education, whether it was in the form of insurance, basic necessities of life suddenly came to light in front of us with the startups enabling this to happen. So the linkage which I'm trying to build over here is the way our whole Indian domestic ecosystem is. There is tremendous opportunities for a startup in terms of delivering to the basic and the small problems. Sometimes what really happens is we're always trying to look at it more from a glamorous terms of what the big names are doing, your Flipkarts and various other names. But there are smaller startups as well which are operating domestically who are trying to solve very local problems as well. So I believe this is just the beginning of the opportunities for the startup ecosystem. I think a lot of startups are also delivering to the global world as well. So they are looking at India from that perspective.
Yeah, thank you. I think Ishwar, more from you because your recent deal. So I know that you should answer this better because your recent deal when we connected and when I was discussing that you are trying to integrate new company, you have done this recent acquisition. So give me some idea about how you see India as a...
Okay, thank you. So just to give some context, in the last 1 year, we acquired 2 companies and we are in the process, actually completed the process of merging, been through a very intense phase through that. To answer, I think I will add on to what Ashutosh said, right? So there are broadly two types of entrepreneurs, right? One who chases valuation, who does a valuation game and so on. The other one who tries to play the long haul. Typically in the last 10 years, especially in B2B, people who have tried to play the long haul have targeted building products in India for Western markets, and that's, after Freshworks, people have a run book for that now, right? So people will continue to do that, but I think the new opportunities are especially around the domestic market. I think India now has a significant domestic market. We cater primarily to the domestic market, for instance. India has always leapfrogged technology, right? We leapfrogged the entire landline era and moved directly to mobile. Jio completely short-circuited the entire broadband and got everybody onto using data. So this is a country of contrasts. I think the same thing is happening in the Indian ecosystem also, right? With the UPI stack, with the India stack, there are large opportunities that have actually opened up for entrepreneurs to create banking products, to create financial products. And I see a lot of this thing happening, catering to the Indian market. Agri-tech, very, very, very big market for India. It's not a consolidated space. Health tech, as more and more Indians come into prosperity, so to speak, people are going to need insurance. People are going to need healthcare. So I think those are the markets that I would put my money on.
Yeah, thank you. So next question, I think maybe I'll take Ram, because you work for Tata Group, and Tata actually basically is a product development company. I would like to know how, what type of acquisition you target here in India market.
So as far as the Tata Group is concerned, as far as the Tata Group is concerned, so there are two broader areas of responsibilities. One is where I work for the group company. So working for a group company is more cross-border acquisitions, where we are looking at companies outside India in the software space. But if you look at, working for the parent, it has been a combination of acquiring assets which are either growing or have grown where we think that we are the better owners. So if we look at the Air India acquisition that we did, it was purely because we felt that we are the better owners than what the government was. And that was the reason, and there's a transformation that is happening in this space where with the merger happening with Vistara, and as well as how we are leapfrogging the competition, Indigo and GoAir. So that's one part of the space. The other part of the space is where we look at growing companies who have built a name for itself, like Big Basket. And then what we do is that we do a strategic investment over there. And then we bring them as part of a super app where customers can get into the Tata app and then do grocery shopping. The third is obviously consolidation space, where we acquired Bisleri recently. It was more about, we already have brands in the mineral water space. We wanted to consolidate the entire market. And because the owner at that point of time did not, the successive generation did not want to take the business forward, this was a good asset for us. So for a conglomerate like Tata Group, the priority has been purely to add value to the Indian GDP. So what we do is that, okay, there is a fair bit of digitalization happening, the fair bit of technology disruption happening. How do we grow the India GDP forward? And what are the areas that we can focus on? Either be it the healthcare, be it the aviation space, be it the traditional software space, where we still believe that organic growth is going to be the better one. And we'll do a lot of tuck-in or roll-ups based on what we feel would be the strategic bets. So that has been the representation with the Tata Group side. But as I agree completely to the fellow speakers that because there is a potential that India has, and because the majority of the markets are not organized, and digitalization has happened, whether through technology we can bring those markets and make the cost of acquisition cheaper through distribution. So we feel that there's a high opportunity there at this point of time, and that's where we do see a lot of entrepreneurship and also a lot of VC investors trying to come and invest in the India space. Yeah.
Nishant, your view?
Yeah, hi. So maybe I'll give you a little different view. Right, I come from a VC background. I've been in a VC space for a while before I started my entrepreneurial journey. So like the growth in startups is very much correlated to something what in VC world we call as a TAM, right? TAM is the market opportunity out there, right? And I believe like in any kind of pivotal shift, there's a cause and effect, okay? there is not one trend which makes something happen. There has to be two trends, which is one cause, one effect. What I think India's story is, in my mind at least, is that there's a pivotal shift where a large portion of the population today in India, as we see, is below 35, right? This is the youngsters, the population which is very, very adapt to learning new things. And this is the digital first population. Unlike other countries where, it's still not a digital first population out there. This combined with a lot of inefficiencies built into our ecosystem, built into our country, is leading to the opportunity which is in India, like of Paytm, right? Something like Paytm was waiting to happen because large population who have apps, who have smartphone, now want to kind of transfer money seamlessly, frictionlessly. So this is what opportunity presented. So this is the domestic opportunity so far which exists in India, which is largely driven through inefficiencies in the structural system, which they are capturing on. Talk about something like Shiprocket, right? Logistics. They recently acquired a company like Picker, right? Again, inefficiencies in the ecosystem, which they are kind of making it more efficient, right? Every place where I can save $1, right, just by improving the processes is an opportunity in India. That's the big TAM. But when you talk about TAM and software business, cloud, behind the screen technologies, undoubtedly I think US is still the biggest market. And it's just the spending power of enterprises there. And I've dabbled with a lot of such software companies in my entrepreneurial journey. And I can tell you one thing, that we as Indians will spend on iPhones. We'll buy good cars, we'll buy good phones for ourselves. But when we run a business, we don't want to spend, we don't want to overspend. We have a budget which we want to stick to. And that's how the Indian ecosystem or the Indian entrepreneurs are built, right? And hence the enterprise software market in India is far less compared to what it is in US. And that's the reason why companies like Freshworks, Zoho, and you see a lineup of other companies now, High Radius, not many would have heard of it, but it's a company started from Hyderabad, doing 100 million now in revenues, ChargeBee. They've all built big businesses outside of India, right? I don't see any enterprise company building a meaningful scale just within India because the TAM is not there. But on the other hand, if you go to B2C, which is what I was talking about in the first one, where there's inefficiencies, there you can build a big TAM because there's a big TAM. So the market opportunity, the growth is there. So I would rather relate the growth of startup ecosystem directly proportional to the TAM which exists in the market. And the TAM in India is today defined only by the B2C category. And that's predominantly led by the inefficiencies in the ecosystem. Whereas in the enterprise, it's still in the US. The US first approach still works.
Okay, so I think my next question is primarily to look at, what is the right time or a stage for a startup to begin thinking of doing M&A. So you can start maybe from you itself.
So yeah, I was part of Netcore. I'm still part of Netcore, strategy officer. So we recently acquired a company called Unbox. This is our third acquisition. We acquired Unbox for 100 million, and I've now joined Unbox to kind of integrate the acquisition. I can tell you one thing, right? Acquiring something and digesting something are two different ball games, right? It's easy to acquire, but how you want to integrate these two companies, obviously two companies will have two different characteristics, culture, two different style of working, right? So this needs to be thought through very, very deeply. You've seen Byju's acquire almost like 20, 30 companies till date. You've seen companies like Unacademy acquire, Shiprocket acquired Picker. So I think a good time to start thinking of acquisition is only going to happen when you feel like you cannot grow as fast as you want to organically. Otherwise, there's no reason to acquire, right? In your own category, like if you're acquiring something for just market access, so the acquisition can happen either to increase revenues in your own category, just that is market access. It can happen because you have ABC product and you want to add a D product for some synergies. Or it can happen because you want to enter a different market altogether, right? These are the three main reasons why an acquisition should happen. And all these three reasons, one needs to think whether you have the processes, whether you have the mindset, and whether you have the bench strength to kind of take over the acquired asset. Because once you acquire an asset, you can be rest assured that the entrepreneurs of the acquired company is going to take his money and going to take a back seat, right? That's obviously a human tendency. So you need to have bench strength to take over that company and make sure that, you know, you do a good job of the acquisition.
So maybe Ram, you can, I have read some of the articles you have written recently. So what is the right time for a startup to think about acquiring a company?
So it depends on what you define a startup is. So obviously we know a startup, if we go by an assumption that startup is an entity that has an idea and where it is going behind a big TAM and is trying to generate wealth, not only for its own stakeholders, but also for the creating job creation, etc. And if the startup is burning cash, that it relies on external equity, like a venture capital. And obviously the venture capital is going to give the startup the money only when the TAM is high. And because they need to ensure that this is a space that is not competitive, go after the space and be like a winner lead sort of a concept. Now you have other space of startups, especially in India, which essentially comes under a category of private companies, where they are chasing a mature market, not a growing market, but they are providing something better, either in the form of a distribution, either in form of a quality. They are not playing the price game, they are playing more of the branding and the quality game. So where they don't burn cash, but they are self-sufficient, and if they are bootstrapped, if they don't rely on external equity, and if they are doing well, then those are the companies they should look at acquisitions. Startup that rely on external funding and who are burning cash may not be the right, and especially during the current recession, where investments have come down for companies either who have not shown the growth that they have shown during the funding stage, or they don't have enough cash reserves. The VCs are not looking to give them high investment rounds. So the investments are getting gravitated towards the leaders because they already have a market, they already have a brand. So in those cases, what is happening, as I see in the startup world, is that because they are not getting funding from the VCs, there's a distressed acquisition happening because they are not even able to fund their working capital and other stuff. So the bigger startup approaches them, or they themselves approach the big startup. We have seen a lot of startups coming to the Tata Group, especially who have been a unicorn a couple of years back, but either because they have the tendency to burn cash, and their entire growth has happened because they have burned cash. And when this has stopped, because the cost of capital has become higher, they are ready to even sell a stake at a highly discounted price. And if you look at those startups, they don't have a sustaining competitive advantage. The only spend they do is in the marketing and advertising, because of which they get users, and there isn't a value proposition which makes them different compared to their competitors. Those sort of startups, I wouldn't advise them to go for acquisition. Look at your growth strategy, ensure that you have a valid sort of product or a service that you can differentiate against your competition. So depends on what stage you are in, what's the macro stage, and if you are good, then you might exploit it to do acquisitions. But if you are not getting funding, then you are in a position where you have to get acquired because you have to survive at the end.
So my another question is, maybe you can answer here, is what happens when companies are already at growth stage? Like you said, Tata Group, lots of company come because they are already billion-dollar enterprise, but they are not able to grow further. So these are the company who come to Tata Group for possible acquisition, or you approach them and try to acquire?
What happens is that the moment the funding from VCs come down, they don't have an alternative. So they approach the strategic acquirers like Reliance, Adani, or the big conglomerates like Tata Group, and tell them that, okay, we have a service, you already have something, we see some potential synergies, and those synergies are imaginary. Nobody knows, because all the synergies that you build, realizing the synergies also requires a cost that you need to put to realize those synergies. So obviously we know that that is not practical. But what makes them to go for an sellout is because the funding from VCs have come down. The why funding from VCs have come down is because the cost of capital has become higher. So that is the entire cycle that is happening. That also happened somewhere in 2015-16 also. So when you see that the three startups that really did well at that time in US were Uber, Square, I think Airbnb. Those three guys came out very well. They also got listed. But you look at the other ones, they really exited or they got acquired. So this has been a cycle, and if you are doing good, it's always better that you focus on cash management and don't burn cash, because it will come to pinch you when the cost of capital becomes higher.
And Ishwar, when you thought to acquire your first acquisition, when you did?
So for me, acquisition or getting acquired is never a strategy. You don't go thinking that I want to be acquired or I want to acquire somebody, right? Like he said, there are broadly three reasons. You want to enter a market, you have an IP that you don't have, or you want to quickly augment your top line, right? So in all three aspects, building it yourself is definitely much, much cheaper than acquiring a company. Especially for a startup, because you pay the highest price when you acquire a company, your equity. This is, you basically dilute, raise around, because most startups are not profitable. You raise equity by diluting and then go ahead and acquire a company. Unless you see very strong reasons. For example, your VCs will always pressurize you to grow faster, but as a founder, you should resist that temptation. Is there an opportunity that you are losing now by not doing an acquisition? Is there a time-bound opportunity that is visible in front of you for 1 to 2 to 3 years? By doing an acquisition, can you bridge that gap faster, and this opportunity might not be available later, right? So as a founder, I would look at it from that perspective, because equity is the costliest thing in the startup world.
Maybe you, yeah. Sure. Yeah, please.
I'll just add one point. Yeah, I'll just add one point to what you said. The only other reason, to be very honest, when you can actually think of acquisition as a buyer, right, is when you acquire an asset where the customers you're getting with the asset, suppose you're getting 100 customers, and the cost of acquisition is lower than the cost of acquiring a customer by your own, right? So I have a CAC is cost of customer acquisition, and my CAC is say 100 rupees. My cost of acquiring a customer is 100 rupees, right? But if I'm acquiring say if I'm acquiring a company which has 100 customers, and I'm not paying 100 into 100 for that, but I'm paying 100 into something less, then it's worthwhile. That's the only other logical reason why.
Agreed, with a small caveat. So that assumes that you're not buying a company, so you're buying a company that's complementary to you, not in the same business line, number one. And my experience tells me that all these CAC calculations, synergies on paper and in reality are quite different. You assume that your cost of acquisition, because you cross-sell, will be lower, but those are just Excel calculations. The reality is when you see the actual numbers. But I broadly agree with you.
Maybe I'll just add one point, because a lot has been spoken on the tangible aspect of things, so there's nothing much to add. But I think we also have to take into consideration the intangible aspect, and that's sometimes the human brain, right? Because as a startup founder, you have lots going on or running on your mind. So it's also about whether mentally you are ready for a M&A or any kind of acquisition or not. I have had these instances with me, and listening to the previous session, where it's one thing doing the deal, it's also about post-deal what happens. So let's say there is amount of desperation that the VC funding is not coming in, or the person believed that he was going to get a higher valuation in the future. Now there is absolute sense of desperation, and in the desperation the person is thinking, am I now ready for an M&A because there are no other alternatives? Then will a person like this, once the entire acquisition happens, give the same commitment to the new entity? So I think a lot depends on the maturities of the startup founders also, when we have dealt with some people, when we have been representing clients, they have actually put us to shame, if I may say so, after some point of time. Because we are representing them, midway through the deal, they suddenly raise their hands and say, I don't think I'm ready for this. I can't sign this contract. I can't give my baby away. And that's because mentally they were never prepared for it in the first place. So I think we have to take into account whether they are there in terms of maturities also to do that part. Very difficult to decide, but that's another aspect I want to add.
Very good insights. So I think my next question is, maybe I will start from you and then we go. What is the right time to hire your corporate development guy, that first guy you hire in your company?
So I would actually connect this to ma'am who had asked this question as well. I think it is about you believing that you are not the smartest person to take that decision. We were discussing this just outside, that you enter a room and you realize you are the smartest person, leave the room, right? Because that's not the right room to be in. I think the same applies to a corporate development guy as well, because I'm a CA by profession, and what happens with CAs typically is we believe that we know everything, right? So you come to a CA and you say, no problem, Companies Act, I'll help you, income tax, I'll help you, M&A, I'll help you, anything legal, I'll help you. But that doesn't operate that way, because once you are into something, you get expertise in that particular subject. Corporate development also is a very niche and a very specialized subject, right? You need to evaluate the transactions based on what's the roadmap which the company has laid down. What is the long-term vision of the company broken down into short-term, into very short-term measures. All these things may not be the competency of the owner of the company. He may only be looking at a long-term vision. He requires someone like a corporate development guy to break it down into smaller, actionable insights. So my answer to that would be that once a company for an M&A, or even I would say 2-3 years prior to that, not even on the day they decide to be ready on an M&A or believed to be, even 3 years prior, when they feel that they're looking at a certain scenario where in the next 2-3 years, as we discussed here, we are going to be, let's say, we have reached a certain saturation point. We will organically not grow. We will need to acquire to grow. Either it could be geography expansion, product expansion in terms of quality or quantity, or it could be, into a different geography, whatever may be the reason. I think at that point of time, you need to have a corporate development guy who sits down with you, helps you break down whatever your thought processes are, and then puts actionable sort of part to it.
Yes.
Okay. I actually have a different perspective. I think that it largely depends on the type of founders you have in a company. So in my company, for instance, all the founders are engineers. In our head, you cannot go and outsource your tech, because if you don't know tech, how can you know whether the person at the other end is actually delivering good tech? If you haven't done sales, you cannot bring in somebody from PwC and say, consult us on sale. You need a sales founder or a very early sales employee who should be able to, there's nothing wrong in bringing somebody external, but you should have a basic competency to understand what the other person is telling you. What the other, so let's say you want to do marketing, you don't outsource all your marketing to somebody, you develop a certain skill in-house and then do it, right? But some companies might think very differently. I don't think there is one right answer. But personally, I did the M&A myself because of the same reason. Because if I bring in somebody from outside and I don't know what that person is saying, I'll most probably be, doing the wrong thing. So the first 1 or 2 acquisitions, I wanted to build it in-house, get the experience, and probably the next time I'll get a corporate person. At least now I know what to ask the person.
Yeah, I think that's good answer.
What's the question? I didn't get it.
When you have to hire your first corporate development guy.
Oh, okay, fine. So, in my view, that's a decision that a CEO and the board needs to take together, because the board needs to know that there is a certain amount of capital that is going to go through acquisitions, and because of which there might be reduction in dividend or whatever the excess cash flow that the company generates. The board has to be okay that a certain part will only go through dividends and buybacks, and certain part will be spent for acquisitions. There has to be a consensus between the board and the CEO. And the second is, once they have decided that there has to be an M&A or a corp dev, and obviously the option is either engage a banker from outside or have an in-house corp dev team. Now, what is very important is that either you can choose any of the routes. Go have a dedicated in-house corp dev guy or hire a banker. But most important thing is that that guy has to have deal skills. Everybody talks about integration here, but that is after the marriage has happened, right? You have to select the right partner. And when you select the right partner, it's not only about what's the upside that you're going to get, but it's also about structuring the deal, negotiating, and paying a price that you feel is that you have got at a bargain compared to the value that you are going to generate, and the additional cost that you are going to spend on integration has to be minimal. So it has to be that will be an ideal acquisition, but never go and buy a company where you need to change the culture of the company, where you have to do a lot of things to realize synergies. Because that means you have paid a cost and then you are doing an integration cost, and we don't know when the synergies are going to get realized. So when you do an NPV analysis, you realize synergies at the year 3. That means you discount the cash flow from the at the present value. That means the NPV becomes not negative. So identify a guy who has a great deal experience, because there are a lot of the only area where I feel there is a lot of potential to improve is to look at the business, align the business with financials, have a bigger picture, and then tie it to the smaller picture. And then the integration will slowly come in, but because everybody knows that culture has to be there, your team management, communication, everything. What is very important is that because you are having a other side who doesn't know much about it, especially if we're talking with startups, because it's their baby, they feel that they have got the best product. And if you don't have a conversation that is pragmatic, realistic, and hinges on the value, you are likely to do a deal which will not either have an approval from the board, or you announce a deal, your share price will tank. And the board will not have a confidence to approve your deal afterwards. I'm specifically thinking about the public company. What happens to a private equity owned company? They're also the same issue. If you have a Bain Capital, if you have a KKR, we are going to ensure that what is the return that they're going to get out of it, because they are going to exit in 5 or 6 years, either through a strategic sellout or through an IPO. So have a great guy with great deal skills. That's very important.
Just one point, based on what Ram said, I think before even you look at the compatibility with the company you are acquiring, you should look at the compatibility with your corporate finance or your investment banker also, because he or she has to understand what is your or match your wavelength. Because if you are looking at a certain way forward, there should not be any kind of upselling on that. It should be sort of compatible to what your thought process or your vision is. Of course, that person may be able to add more value and give you a better direction, but both of you have to be on the same page, and you have to be believing that both have the same vision in terms of the way forward. Otherwise, it can be a disaster even before you go and speak to the acquiring team.
One big challenge with the bankers that I've seen is that they don't care about your value. They care about the success fee. So what they want is that they want to consummate the deal, get the success fee done. So if you are going to rely on the banker for the decision that you have to take, then you are not doing the right thing. So the banker is only there to give you targets. But again, the deal sourcing also has to happen internally. Apart from that, the banker doesn't play a lot of value addition. And if you cannot rely on a banker on a valuation or on the business fit. That has to be done in-house.
So maybe, Nishant, if you can give some idea.
Yeah. So I have a very different perspective on this. All right. And maybe before I give my perspective, some background. I've been in M&A for almost today's 13th year. Did 10 years of M&A with E&Y. Did multiple deals for Infosys during Vishal Sikka's time, and then did a few in other stints as well. So for me, corp dev needs to be clearly defined, right? Corp dev deal origination? Is corp dev deal process? Is corp dev deal consummation? Or is corp dev post deal, right? Integration? Or is corp dev all of this, right? for any company, even for Netcore, right? I'm part of Netcore, right? When we looked at acquiring Unbound, it was a $100 million deal, cash, all cash, no equity, right? And for us, it was a big decision whether to do it or not. And we didn't use a banker, we did ourselves, right? Now, the deal origination, why should we do this deal, right? Has to come from the founders or the board, right? It's like what Ram said, right? Who are you going to marry? You have to decide, right? A corp dev guy is the pandit. He'll get the marriage done, right? He's a process manager. Hello, yeah. He's the process manager. So he's going to come, he's going to say, okay, we'll do a due diligence on the target. We are going to we'll open a data room, we'll open a data book, we'll do a financial diligence, we'll do a legal diligence, we'll do a commercial diligence. He's going to give you a bunch of reports, right? And at best, he'll do a DCF analysis and give you a valuation, right? At what valuation will you do the deal? But eventually, what is most important is when you're conceptualizing which kind of company you want to acquire, why you want to acquire a company, coming back to those 3 reasons, right? Whether I want to enter a new market, should I enter it organically, or do an acquisition, create a beachhead strategy, and then get into the market. I have ABC product, do I need to add a D product, a new IP? All of this is what is essential. And that's where the strategy comes in, right? And the strategy has to be discussed with a group of people at the helm of the business, not just one, because obviously we all think that what we think is the best, right? But this needs to be bounced off with a group of people, and that I think is the most important thing. Everything else is just details, right? And what is the other most important thing is towards the end, right? Like with us, right? It is easy to get married to someone. It's very difficult to stay married, right? So it's easy to kind of find a partner. We can all say that, look, the wavelengths match, you know, I like this girl, I like that guy, we are meant to be together. But in every kind of relationship, you know, you have to live every day, right? And no 2 siblings coming from the same parent have the same personality, right? So no matter how much we try, 2 companies will have 2 different personalities, 2 different culture for sure. But do you have the stomach to kind of take in, and do you have the maturity to kind of absorb that? That's really again another test. That is post the acquisition. It's the same with humans, right? Like, I'm sure a lot of us have siblings here. Like, does anybody have the same kind of characteristics as your sibling? No. Same parents, same house, everything same. Probably same school, but still we are different, right? It's the same thing. So, so I think the origination, where the idea is coming from, why should we acquire, right? What kind of company should we acquire? That's important. After the acquisition, how do we spend the rest of our lives together? That's important. Everything in the middle is just process.
Yeah, so I think part of my next question you have already answered. So how to build M&A strategy? Like if you have to build M&A plans for your company, what are the key challenges you see? Who are the people should be involved? How we build that system?
So I'll give you one anecdote. When we were doing a deal for Infosys, this was back then, I will not name the company, but there were a few deals. You guys know during Vishal Sikka's time. And one of the key things which was very clear is, if we are acquiring a company in a certain business, is there a sponsor in the buyer ecosystem, or in this case in Infosys, who's putting his hand up and saying, hey, let's go acquire this company. I take the responsibility of post-acquisition, assimilation of this business, right? I take that responsibility. That is important, right? And that is really important, because after the acquisition, you don't want to pass the buck saying that, hey, you told me to acquire, I've acquired, now what? That guy says, you told me to acquire, now I've acquired, but he says, look, I just gave a suggestion, right? So what is important is, if there has to be a sponsor for the acquisition in the buying committee, right? Or the buyers group, as we say. And every big acquisition should have a sponsor. And you should acquire a company when you know that you have the bench strength to make that acquisition. If tomorrow, after acquisition, if the founders of the target company leaves and goes, in this case, obviously they make their money and they take a backseat, or, you know, for 10 years, they fought it hard and Now they've seen some money, so they're going to be a little relaxed. It's human tendency. You have the people who can take over. I think that is a good acquisition to make, or is it? It's at least a good starting point.
Yeah, maybe.
So I think it was about the strategy for M&A. So I think again we are coming back to a bit of competency mapping over here, you know. And I remember when Ishwar sort of completely agree with what you said in terms of you need to first analyze between the founders and the core team how much of it you can do in-house. And I'm definitely of this opinion, because many times when guys come and they say that we are starting a technology company, and when you ask them who's going to make the technology, they say it's outsourced to a third agency. This is like the recipe of disaster, right? Because if the main objective of the company or the fundamentals of the company are not, the competency doesn't lie in-house, you're relying on somebody else. And I've seen umpteen number of times that person leaves or has better things to do in life, the whole organization fails. So again, when you're doing any kind of an M&A, first you need to analyze, do you have people within the organization who have those competencies? Now, for example, Nishant, as you mentioned, you have that history where you have that competency which is there, or you've gained it, and all of us over here probably are into M&A. But typically what happens with owners they are technocrats. They are not from that particular background. Either they learn through the process, or they have some member of the core team where there is an element of knowledge, because that person has learned that whole process throughout. When I say learn the process, not in terms of education, but in terms of experiences, which are very important, failures and successes. Or that person has to be sort of brought in, as we were talking about the corporate development person, where you are assigning him certain parts of the role, where you say that, okay, these are the 5 things I'm very clear about. I give contours of the deal. I say that, okay, these are the things I want to go for. This is the geography, whatever those parts of the things are. But beyond that, where you believe your competency doesn't lie, whether it is searching, scouting for something, whether it is in terms of the valuation negotiation, contract drafting, due diligence, you need that kind of a support. So I think competency mapping is what I would put it at, in terms of understanding where am I, what kind of competencies exist in-house, and then looking for the right person with whom there's a technical compatibility and a personal compatibility to take on board. So this is what I would say.
Yes. Is there any other additional point you have?
Sure. So, sorry?
Don't take this step.
So, see, when you get into an acquisition, you don't go with the mindset saying, I'm going to merge the company or I'm going to leave the company alone. I mean, a lot of people assume that acquisition basically means I'm going to merge it into the parent company. That need not be the case. You don't get into, so basically, firstly, you put out and you map it out, you say what are the synergies that are possible. Is it going to increase your addressable market size? Is it going to decrease your cost of acquisition? Is it going to grow? I mean, by yourself, you're growing at 30, 40%. Put together, can you grow at 70%? You do all of that, and you leave the decision on whether you leave the company separately, you put money into the company, let them run separately, or merge them into the parent organization. You leave it to the process on what comes out of this, right? You don't go in and say that I'm going to integrate on day one. It can happen immediately, it can happen in 1 year, it can happen in 3 years, and in a lot of cases it need not happen at all. I think that is one thing I would say. The second thing is in terms of leadership. When you, let's say you're going to merge, let's say you're going to integrate it into the parent company, conventional wisdom from a lot of consultants I've spoken with says that people want to know what the leadership is going to be. You need to announce it on day 0. At least in the cases that I've personally worked with, those things have backfired. What has worked for me is you put 2 competing people, there'll be 2 HRs. You put them together and then you say, this is what I'm expecting as an outcome. And then you see who performs well, and then you give the role to them, right? Similarly to finance functions, especially support functions, you will have 2 heads. You don't get into it saying, this person is going to be the leader. You let it emerge out of that. So these have been some of my learnings.
Okay, so now this is the last question. So primarily, I want to focus on how Indian startup company can think of building or acquiring company out of India. what should be the strategy for, because not many Indian company acquiring company out of country, right? It's mostly, within country.
Probably I'm not the right person to answer it. We are a B2B company building in India and selling in emerging markets. It makes no sense for us to acquire companies outside of India.
Your case, I know.
So maybe I can start. Look, we acquired Unbox, which was based in US, and we are based in Bombay. Okay. For us, the way we thought about this is, so the parent company, which is Netcore, is predominantly present in India, emerging countries, Middle East, those kind of places, and Unbox was present in outside of India, right? So for us, the choice was whether we can build it ourselves organically, and how long will that take, what will be the cost of acquisition on Excel, or kind of create a beachhead strategy through another company, dive into the market, gather, hit the ground running, right? Have 100 customers on day one, and then figure out how we cross-sell and upsell and those kind of things. Of course, it's a far more difficult decision to make, because you're dealing with something which is not down your road, right? It's not just close by to you. People are different. It's a different organization, different culture. But I think more and more as we speak, I think this is happening, right? I think people are making those kind of moves, a little more daring moves, so to say. And the call for that is because otherwise, just getting into the US market, and predominantly the reasons is that for us it was that we don't have access to that market, and how quickly can we get access to that market? And for us it was a huge learning curve, because the way you sell a product in India versus the way you sell in the US is vastly different. The way you write emails to Indians, the way you write emails to the US is vastly different, right? So it's a big learning curve, right? And for that reason, we kind of thought we should kind of make this bet. So far, it's been paying off, but that's one of the reasons why we decided to do this, really. In terms of building strategies, like I said, this is to be thought through with a bunch of people really at the helm, along with your investors, whether there's support, there's no support, what could go wrong, have base case scenarios, best case scenarios. Obviously, none of that could work, but you at least have a starting point, right? And you at least have a direction to go forward. And obviously, choose the company wisely, because in our case, we chose a company which was a US company where a product existed which we didn't have. It was a great product for us to add, so it checked out all the three reasons: new market, new IP, and as well as more scale, right? So for us, it made sense from that angle.
Yeah, maybe Ashutosh, Ram.
Companies in India acquiring outside. I think that has been happening in the IT services and as well as in the technology end. And see, the rationale is purely there are certain areas where some countries are good at. So if you look at US technology and pharmacy, pharmaceuticals are very good. So if you are going to be a big player in either in the tech space or in the pharma space in India, then you are going to get the best capabilities in US, and it makes all the sense for you to go and acquire them, either in terms of IP or either in terms of building customer relationships, because you have the biggest buyers there and you have the innovation happening there. So already that has been happening in the IT services end. So if you look at HCL doing a lot of cross-border acquisitions, Infosys, and primarily the acquisitions was centered on access to customers, because most of IT services revenues come from US and developed markets. And they are chasing those customers, and you acquire a company who have access to those relationships. The second would be the IP. Obviously, Indian IT services companies, they don't focus much on software, but we did an acquisition way back in 2016 when we acquired IBM software when we were at HCL. So at that time, it was around $2 billion deal value. It was an entry into platform space. So where we wanted to create a new segment called HCL software, which is not related to the services end, because we felt that no matter how digital transformation is going to come up, it is going to be a rare commodity. And ideally, the growth and the margins has to come from the software end. So, and there have been good success stories. So it has not been the case where we have struggled. In US, Europe is slightly a different challenge. The employees are very much tuned to acquisition. They know that what is going to happen. You don't need to do a lot of hand holding to them. After integration, they know that if they want to leave, they will leave. They want to stay, they know. And many of the people who have transitioned from IBM to HCL, they are continuing to stay over here. And as long as you don't encroach their space and give them the sort of environment that they want, they don't care a lot. So it's not like a shift that is there in the, other markets. Germany, there is an issue primarily because of culture. And there's they feel that if some outside country acquires them, then it's matter of some sort of a thing for them, and language issues. So in those cases, it's always better that you have a in-house German team, the buyer, who understands the culture, understands language is very important. So that has been the case with Nordic as well as in German. US has been the easiest place if you want to do acquisitions because the laws favor the buyer, not as in Europe where the laws favor the seller. And the employees are they are very much attuned to what is going to happen after. The change management is not going to be an issue. And third is that you are going to get the best. If you are looking at innovation capabilities, US is still the #1 country. Japan is also a problem. So I think US, so Indian companies have been successful in cross-border acquisitions, especially as services businesses.
Any other point?
Yeah. So I think I would like to borrow from the previous panel discussion in terms of why. I think it comes down to that question of why do you want to acquire a company abroad. So one is it could be because the market in India is saturated, and for that you really need to be in a very niche space in a country like India to be actually reaching that point. Second is where your product or a service is of a kind which is more suited to the US market or to any other global market, where you believe that you will be able to get customers there better or get a better margin for your products. Or it could be the other elements like the IPs or any of that sort of a thing. Now, what I really believe is for the larger companies, probably the infrastructure is already developed where they can look for the right kind of a company through their networks, associations, for a startup typically, which is in the growth phase and are looking for that kind of an opportunity. A startup really needs to do a lot of research in terms of understanding that market first of all, because beyond the company which is going to be investing into, there'll be a lot of regulations around that particular country. There will be a lot of labor laws, and I've seen a lot of guys falling prey to the labor laws part in terms of severance and several other things. It's unfortunately or fortunately not like India. So you need to be very careful first to understand the macroeconomics of a market, then to understand which is the right company within that. Do your due diligence thoroughly in terms of the company if there are legacy issues and various other things which could be on you once you buy that particular company, or what is the kind of right structure you need to do to acquire the company without taking the issues on you. And then the legal agreements. I think, many times what I've seen is we just tend to take the legal agreements sort of for granted. There have been, of course, not for the larger ones, but for startups, what generally happens is that, no, I know you, you know me, let's just draft a 2-pager, and that's the end of the story. Kaun dekhega, aage jaake dekh lete hain. And once that happens, you are starting with on a wrong note completely. So especially when you're doing a cross-border transaction in place, they always say, once you sign off the agreement and it goes into your drawer, the day you have to remove it out means your deal is ended. So it should never be actually seen again. You should never to refer to it. So I think these are the steps one can take, a startup can take, before it looks to a cross-border acquisition. But as Ram said, I think it's more and more happening now. I think, and that's a great news for all Indian startups.
Yeah, thank you. So I think we have lots of other questions. So we'll leave people to ask.